Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. All right, there's a lot of news that I have tried to cover today, but we're going to start off with talking about the Fed interest rate hike of 75 basis points, which is 0.75%. We're going to talk about what it means, what it is, and why I don't think that this is the key point of information that you want to make an investment decision off of, because you're going to learn even more tomorrow and the day after that. So we're going to cover all of that in this video. We're going to try and do it in less than, let's say, 10 minutes. Okay, I'm gonna try and keep this relatively short. Y'all know I like to talk, but let's go ahead and get into it. So the Federal Reserve again raised interest rates by 0.75%. This is the second time they've done it in a row. These are the most aggressive rate hikes we have seen since the 1980s. The last time inflation was way out of control. Now, we know that the Federal Reserve at this point starts to do this, or tries to do this, to impact demand. What they try to do is say, look, y'all need to slow down, stop buying so aggressively, so I'm going to make things more expensive to prevent you, or at least discourage you from doing that. Now, unfortunately, that is not the only thing that's wrong with why inflation is where it is. Remember, back in 2020, we had all these shutdowns and the supply chain was completely broken. That is the main issue, in addition to what is happening in Russia and Ukraine. So, unfortunately, the Federal Reserve cannot wave a wand and make a factory to produce more stuff. They can't do that. They can't wave a wand and stop international global conflicts. We wish that were the case. That is not in their purview. It's not in their toolbox. It's just something they can't control. What they can control is interest rates. It's one of the only things that they can do. It's the main tool that they have. And in the past, they would lower interest rates when things were bad to get people out there and spending. It worked in 2007, 2008. It worked in 2020 when we were in and out of a recession in what felt like record time. So now that inflation is way too high, they say, look, the one thing that we can control is making borrowing more expensive, to discourage people from charging things up on their credit card and going out and buying houses and business loans and all these other things, to slow things down. It's the only thing they have, and we're going to find out really this coming Friday whether or not this has worked. What we learned 2 months ago is that inflation, even though they started to raise interest rates, was still at 8.6%. And then last month it was 9.1. This coming Friday, we're going to find out and say, look, have these things started to slow down? And that's what we are looking to see. So to give you a better picture of what this looks like, because a lot of people say, oh, well, where interest rates are high or they're going up, like, what does that really mean? I'm going to put this graphic right here, and this is from CNBC, and just really give you a crystal picture. So on a $300,000 loan, a 30-year fixed rate, that's when you buy a house, you pay for 30 years, at least you're supposed to anyway. You pay it off faster, you save more money. But in any case, in December, which I bought mine in August, so this is pretty average, a rate of 3.11%. That was, which are, with that, a $300,000 house paying 3.11%, the average payment for that, or the monthly payment for that, would have been about $1,283, so $1,283. Today's rate, which is 5.54, brings that payment from about $1,200 to $1,300 up to $1,711. That's an extra $428 per month for the exact same home, assuming that that house price did not change. That's an extra $5,000 every year, and $154,080 over the lifetime of the loan. Okay, I know it's a mouthful, but think about it. The same house, right? Assuming the price didn't change, the exact same house, and the interest rate is the only thing that changed. So it goes from 3.11 to 5.54. And I've added an additional expense for the exact same house, $428. So what seemed like a deal in December, you're probably like, I don't know if I want to buy that. I want to figure out maybe the price of the house will come down, which would be most beneficial, and slow people from borrowing. That goes for credit cards. It goes for anything that you need to borrow money for. So houses, the loan for a house is going to become more expensive. The loan for a car is going to become more expensive. The loan, which is basically where a credit card is, that's going to become even more expensive, which disincentivizes people to borrow for those items, which should, in theory, bring down the house, or the value of that underlying asset, like a house. Because if you remember, and some of us have been in this for a while, when you were going out and buying houses, at least I was trying to, my wife and I, we were out there and people were buying houses in minutes. We would get there, we'll say, oh look, this house is on Zillow, let's go out there, and the house is gone. Because people were buying up things left and right, and things were more expensive. People were paying over asking price. That stuff is starting to slow down now, and we're going to continue to see that. So hopefully this should start to factor into these inflation equations. We'll see. We will see. Okay, so that is what's going on with inflation, or I'm sorry, that's what's going on with interest rates. We're gonna find out tomorrow on Thursday the official, declaration of whether or not GDP has constricted, has shrunk or shrunk in, however you want to say that, in Q2. That is the official definition of what a recession is. Now you've got other people that want to redefine it all of a sudden for whatever reason, but that has always been the definition. You can go check out your economic textbook, and it's going to tell you the same. 2 consecutive quarters of negative GDP growth. It is what it is, okay? Now, the other thing that you need to know is not every single recession is the same. Some are mild, some are bad, right? The one in 2018 was not a recession. The market was negative in 2018, and that was mild. But in 2020, that recession was bad, and it was in and out relatively quickly. Right, less than 18 months. The one in 2007 lasted a bit longer and was a lot more severe. The one in the early 2000s lasted a lot longer, and it was, again, a lot more severe. We'll see what it is right now. There are some that say, look, employment is still good, spending is still good. You may have a technical definition of a recession, but it not feel like a true recession. There's a case to be made for that, but we're not going to know officially until tomorrow at 8:30 a.m. Then on Friday, we're going to find out about inflation. The market is going to do what the market does, right? We've seen already what's happened with Google and Microsoft, and at the time of this particular recording, I'm recording around 2:30, the market is doing real nice, at least as of today. So we'll see where things continue to go. Now, what do you need to know as an investor based on all of this stuff? You need to continue to focus on your plan and choose investments accordingly. I cannot tell you where the market is going to go by the end of the week. I can tell you with confidence that over time, the market is going to continue to be up. And the most important thing that you should be paying attention to is the business behind the stock. Okay, the business behind the stock. There are a lot of stocks that are up by X%, others are down by X%. But there's a difference, and I've said this before, between a Microsoft, because we talked about Microsoft yesterday, an Alphabet that's down, let's call it 20% on average between the two. Those are down, but those are still making money. I could argue that it's slowing down a bit, but Microsoft, for example, we talked about yesterday, they're growing by 12%. It's their slowest growth since 2020, but you're still growing. Not every company is in a position to continue to grow. We'll find out what happens with Meta here pretty soon. We know that companies like Snapchat aren't necessarily growing. That is a problem. So when you start to decide what to invest in and what not to invest in, pay attention to growth. Who is still growing in this time? How much are they growing? And are they actually bringing in money? Or are they losing money? Perhaps something like a Twitter or Pinterest. I mentioned Snapchat. See what Netflix is doing, and see those different trends. You can find this out from the investor relations page. You can read news on these, since it's a lot of news about these companies due to earnings here in the last few weeks, but also the next coming few weeks. That's what's going to separate you from being able to find a deal right now, something that's going to pay off in the next 5 years, and something you're going to continue to lose money in. That is the key in a time like this, and that's always really been the key, honestly, but it's definitely a key in a time like this. Another good thing to pay attention to: see where people are spending their money. I don't necessarily mean consumers. We talked about that chip bill. I talked about chip infrastructure stocks like Nvidia, like Intel, like Micron. That bill did pass, the $52 billion bill. This is very similar, while it's not the same dollar amount and things like that, it's very similar to infrastructure stocks last year, where we talked about roads and bridges and all the things that we actually need. We tracked that bill, we saw what was going on, it did get passed, and those stocks did do well up until really January of this year. So again, pay attention. That's $52 billion going into the industry. That does not mean that one company is going to receive all that money, nor does it mean it's going to receive it tomorrow or all at once, right? So keep all that stuff in mind. Where are people spending money? Where do you see insider buying activities? Because we saw what happened with certain Congress members invested like 20,000 shares in some of these companies. And then it just so happened that, 9-10 days later, that bill did pass. Should it be illegal? Yes. Should I be aware of it? Yes. Okay, so pay attention to things like that. So it's are you still growing in a time like this? Are you still bringing in money? Are you growing or are you shrinking? And then where are these insiders spending their money? Right? Where are they putting their money in a time like this? Once you start to track those, you are going to be, one, incredibly successful, but you're going to place yourself in a position to win, not just in 2022, but 23, 24, 25, and so on. So those are things I want you to pay attention to. Now, the last thing we'll talk about today is the chip bill. Again, it did pass $52 billion. Believe it is on its way to the president because I think it passed the House last week. But I'll continue to track that. What I want to do is kind of do a breakdown or a list of some of the biggest chip manufacturers and kind of rank them in order of which ones have the best growth potential over the next few years. If you want me to do that, let me know. I don't want to spend time doing something and then you're like, yeah, I don't want it, right? So let me know what you want me to cover, what topics you want me to talk about, and we can do those. For, I guess, my last thing before we go, like always, make sure you check out the members only community. We talk about exclusive things and deep dives. So when people ask questions about can you cover X doc, that answer is yes. It'll be inside the members only. All right, that is it for me. There is even more news for me to cover because I know somebody's reporting earnings in the next few hours or so. So, whew, I'm tired. Rest in peace to Choco Taco. All right, I'll talk to y'all later. Bye.